there are very specific reasons that Credit Suisse is finding itself in this position. You may remember the Greensill scandal. It was caught up in that. There were big issues over Mozambique, its investments there. It was also convicted in last year, in the summer of last year, of failing to prevent money laundering. It unveiled a big turnaround plan. It announced a $4 billion loss last year. Speculation clearly over its financial health, whether it could meet those repayments, whether it could meet those loans. And now just the latest suggestions in its delayed company report that it was reporting of material weakness in its financial controls.
Well, picking up on that material weakness is Victoria Scholar, Head of Investment at Interactive Investor.
It's 5-year credit default swaps, which is essentially a measure of the cost of insuring against buying its bonds. So it gives you a clue about how risky its bonds are, have soared to a new record high. Like you say, this week it found material weakness in its financial statements and that it's been unable to stem outflows. But the latest is that its biggest backer, the Saudi National Bank, isn't going to be providing any further financial support, and it won't be going above 10% in terms of its holdings. So the stock was actually halted after its second day of decline.
Well, confidence in the sector took another knock late on Tuesday when the ratings agency Moody's revised its outlook on the US banking system to negative from stable, citing heightened risks for the sector. A spokesperson for the US Treasury has said that it's monitoring the Credit Suisse situation. Here's what the EU's Commissioner for Finance Services told the European Parliament in Strasbourg earlier today.
We can say that the EU banking sector is in overall good shape. It has built up its resilience in recent years, and it is supervised closely by national and European authorities. But I think at this very early stage, we can start to look at some of the lessons that these failures in the US have for the European Union.
Well, let's cross over to get some analysis from Susanna Streeter, Head of Money and Markets at the Investment Services Hargreaves Lansdown. Susanna, welcome. Let's just focus in on Credit Suisse. Is there a real risk that it could go bust?
I think there is growing concern about just how robust the bank is, particularly when we hear that Swiss authorities talking to the bank's management to try and work out the way forward, and alarms have been raised by at least one other European government asking authorities in Switzerland to take action to try and restore confidence. Certainly the bank had already been experiencing problems, but what's happened right now with this banking rout and concerns about the impact of the SVB Silicon Valley bank collapse and the impact on smaller banks in the US is that investors are really sniffing out weakness and voting with their feet, exiting positions they think are too risky. And that certainly seems to be the case with Credit Suisse right now. So we'll have to really watch this space. There are plans for, if the worst scenario does emerge, a kind of orderly exit that was set up after the financial crisis, but we haven't had really a need to see this. And certainly what I would expect before we get to that point is that perhaps some kind of backstop being offered to Credit Suisse in terms of stopping further deposits leaving the bank.
And when we talk about material weaknesses that were described in the report, just help us to understand what that means in layman's terms.
Well, certainly what's happened is that the bank has said, we've gone back, we've looked at the way that we've analysed our accounts, and perhaps we haven't spotted where more risky bits of the business have been. Now, it's unclear exactly the full detail of what they're referring to there, but certainly some of their risk management left something to be desired, and that has certainly sparked fresh concerns about just what's happening at Credit Suisse. And that's why you're seeing this fight today, but also the very fact that actually one of the investors, a Saudi National Bank, who invested in the bank when it raised capital through an equity raise late last year, said it couldn't actually invest any more in the bank because of regulatory concerns. That led to worries that there wasn't any kind of easy exit from this situation Credit Suisse has found itself in. So certainly what we're hearing now is that negotiations will be taking place to try and come up with some form of reassurance to stop an exodus of deposits from the bank.
And while all that's happening, of course, we've been talking about this for a number of days now. A lot has been talked about the interest rates being hiked. Helped us to just understand the link with higher interest rates with what we're seeing now with these banks.
Well, when interest rates are hiked very, very quickly, that affects the value of bond holdings. So they drop. The value of bonds drop as a result. And what happened is that some of these banks, including Silicon Valley Bank, actually bought a lot of these bonds, hoping to get a higher return over a longer period of time. But effectively, it used the deposits that its customers had put into the bank to try and make this return. And then when interest rates have spiked, it meant that their bond holdings were worth a lot less, but it still had to sell them anyway. And that's where then we saw this exodus of deposits, this worry that actually the bank could turn insolvent, which it eventually did. And the worry is that perhaps other banks are sitting on big unrealized losses. That's not a problem if they don't have to sell them, they can hold them to term. It is a problem if they're forced to sell them because deposits are leaving. And that is why there is so much nervousness around at the moment. And the worry is that actually that could happen more, particularly for regional banks in the United States.
Susanna, really good to get your clarity there. Susanna Streeter from Hargreaves Lansdown. Thank you.